Good afternoon, class. All right, so I broke it down into concepts and calculations. So again, we're going chapter 7 and 8. Chapter 7 is all about stocks, and chapter 8 was all about how to evaluate investment projects, right? So let's start off with the concepts up here. And so these are some of the concepts having to do with stocks. And some of the things that we talked about with stocks are, one, how they're sold in terms of different types of offerings, because the reason companies sell shares of stock is to raise financing. Just like in the previous chapters, we've looked at bonds, and companies sell bonds to raise financing. They can do the same thing with stocks. And so when a company sells shares for the very first time, a private company sells shares in the public markets and therefore becomes public. That's called an initial public offering, or IPO. And that takes place in the primary markets. That's when shares are sold for the very first time. Now, later on, let's say you bought a share in an IPO. Now, if you want to resell the stock to another investor, the company has nothing to do with that, right? It's just between you and the other investor. Those shares are sold in the secondary markets. And we also have seasoned equity offerings, SEOs. And they're basically when companies decide to raise capital again, but they're already public. And so they have the right to do that. And then we talked about, primary markets, secondary markets. And when companies want to give money back to shareholders, they can do that through issuing dividends, which is a cash check that they send directly to shareholders. But actually, it'll end up going into your brokerage account. That's how you usually will see it. It'll go into your cash account within your brokerage account. So those are just some of the basics on stocks. And then we looked at some of the different ways that we have for valuing stocks, figuring out how much they're worth. Because just like a used car, there is no one number out there that says this is the true worth of a car. So we have multiple ways of looking at the value of a stock. And we looked at using book value. We looked at using market value, which is the trading price, the current trading price. And you might think, well, isn't that really the true value? And it is the true market value. But remember, sometimes markets can do crazy things. And based on what's happening in the world, you get some crazy prices. And so market prices may not always reflect what the true or long-term value of a security is. Then we spent a lot of time on the dividend discount model, and we'll look at that more today. And we also talked about liquidation value for figuring out how much a company's worth or stock, and that's where you sell off all the assets and then pay off all the loans, and whatever you have left is the liquidation value. And that's kind of almost like a market value balance sheet, if you will, in a way. That's kind of the money left over when you take assets minus liabilities. From a market value standpoint, that's kind of like liquidation value, really, if you think about it. And then we talked about these efficient markets and behavioral finance. And efficient markets are the way academics kind of look at markets and market prices, and our ability to try to explain stock returns. So we build models that predict stock returns. And if efficient markets are true, we couldn't really forecast stock returns like, oh, this stock's going to do really well compared to the average in the market, and this stock's going to do really poorly compared to the average in the market. So efficient market says you shouldn't be able to do that. But we do find when we look at certain types of investment strategies that you can earn some abnormal returns. But the problem is, for the average investor, it's just not really doable. For example, like, over the last 40, 50, 60 years, we know that value stocks that are relatively cheap in terms of like PE ratio, they outperform expensive PE stocks like growth stocks like Amazon and Netflix. And you might think that's not the case, but over the long term, that's the way it works. But sometimes with these academically generated investment strategies, they don't work every single year. They might work 6 out of 10 years. And it's that extra year where you get that adds up to an above average return. And that can be frustrating for a small investor to do. And the other part of it is these academic investment strategies often rely on having big portfolios of a certain type of stock. So like if we think cheap PE stocks do better than expensive PE stocks, it's not like we just buy one cheap PE stock. No, we build a portfolio of 100 or 200 of those stocks. And that's just not practical for most investors. And so for all intents and purposes, markets are pretty efficient where it's really hard for people to really beat the market, beat the average. And so most investors should really just focus on having a diversified portfolio through something like an index fund. Now, some of these strategies we kind of explain away also with behavioral finance. And you can think about it as like psychology. And it's psychology trying to explain why people do things that isn't in their best financial interest. And we've seen it happen. It could be because of hubris. And by hubris, I mean like overconfidence. Like, oh, I know I can invest really well, and I'm going to start, day trading. And because I saw some commercial or read some book, I should be able to do it, right? But, most of the results on smaller investors studying this type of thing, the results don't usually look good. And so part of that we explain with behavioral finance and trying to understand how people, either they're overconfident or they're ultra afraid of any type of risk. Therefore, they don't invest in stocks at all, or they just want to do what other investors are doing. So these different traits explain why markets may not be efficient all the time. So that was behavioral finance. And then we, let's see, and then we moved on in chapter 8, some of the concepts. We started with the NPV rule. And can anybody write in the comments or just go ahead and speak it out? So what is the NPV rule? When do you invest according to NPV?
When the NPV is greater than 0, I believe.
That's right. Exactly. Yeah. Yeah. You got to commit that one to memory. Don't be looking up that one on your cheat sheet. That one should be a no-brainer. NPV greater than 0. That's what you want. And if you got a project and it's NPV of 0, then just tack on a 1 somewhere in your cash flows and you'll be good to go. Okay. I was once working on I can't remember if it was a new product line or a company we were going to buy. And the guy he's the CEO of Emerson, he said, those numbers don't look right. Make that third year, make that one look a little higher, and the fourth year just a little bit higher. that'll way it'll look a lot better. So it's not always science and fancy surveys and big forecasting models. Sometimes sometimes it is a little bit like that in terms of how decisions are made. How about the IRR rule, internal rate of return? What's that one about?
I believe, if I'm not mistaken, that IRR got to be greater than the cost of capital. Something
Exactly.
Like that?
Yeah. And remember, IRR is kind of it stands for internal rate of return, and so it's your average annual return over the length of the project, right? And cost of capital is what the minimum baseline, what your investors expect to have come back to them. And so think about it like this. We mentioned how on investment projects, we keep financing and investment decisions separate, right? But there are some projects where they're intertwined, where the project wouldn't happen without the financing. And you might see that with real estate projects a lot, right? It all depends on whether or not you can get the mortgage. And so just imagine right now, if you could get a mortgage for a piece of property, let's say it's some kind of investment property, I don't know, or maybe you think you can, fix it up and turn it around. Let's say you get a mortgage of 3% interest per year. You can almost think of that as your cost of capital, right? That's what money's costing you for your business of buying this property. And so now when you go ahead and let's say you're going to buy this property and then you're going to like fix it up and increase the value of it or something, or maybe you're going to hold on to it for 10 years and then sell it. What this IRR rule basically says is that the average annual return on that property you're going to buy needs to be higher than the loan, than the mortgage. It's kind of, I guess, maybe it's a no-brainer. It makes sense, right? But if you're borrowing money at 3%, whatever you invest in has to be higher than 3%. And that's kind of like how this IRR rule works. And so you can definitely apply it to real life. Anytime you're borrowing money for some type of investment opportunity, you got to make more in your investment than it costs you to borrow the money. So that's kind of a, I won't say no brainer, but that's basically what the IRR rule is saying. And then we talked about the payback rule. And in the payback rule, we just looked at how many years it took until we could earn back the money that we invested, right? And we don't have a cutoff criteria that's theoretically, academically derived as the optimal cutoff criteria, because this doesn't take time value of money, compounding of investments, that kind of stuff into account. So it's pretty arbitrary, and that's the problem with it. We don't know what a real good number is, but certainly if you tell me you have an investment with payback in 1 year, that's probably a pretty good investment. I got to imagine it's probably going to have an MPV, probably pretty high as well.
Professor, generally speaking, would majority of organizations calculate their payback periods, or is it like certain type of organizations would do that?
No, I never calculated it. I worked for two big companies, and within those two companies, several divisions each, and it was always just NPV and IRR. That was it.
Okay, makes sense. But yeah, my main question for that was, when they calculate those payback periods, would they be looking at the whole number or like the fractional number? Because I know you brought that up and you really didn't tell us how to calculate the fractional number, but I just wanted to know which one would they rather look at? I'm guessing, of course, the fractional number since it's more precise.
Maybe. I went through the textbook quickly, and it looked to me like it did whole numbers, right?
Yeah.
So that's why I didn't want to confuse the situation. Basically, you look at the percentage of money left over in that final year and calculate it as a percent of the total cash flows for that year only. We'll do an example of payback period, and maybe once class is over, we'll look at how to do a fractional. Okay. We talked about the relationship between the risk of the project and the discount rate. And the key there was that when something's riskier in finance, you should get higher returns. And so it works the same way when we're taking NPV. If you've got a really risky project, then your discount rate needs to be higher. And that's key wherever you go in finance. The risk and return have to kind of compensate for each other. And then we talked about NPV and inflation. And the key there was that if you want to use nominal cash flows, then you need to use nominal interest rates for your discount rate. And if for some reason you want to take out the effects of inflation and use real cash flows, then you also need to use real interest rates. And as long as you're consistent in doing that, then your calculations should be fine. Everything we do, pretty much from what I've seen in the textbook, it's all about nominal dollars and nominal interest rates. And that's the stuff we deal with in real life. So as long as you do that, I think you're good. Okay, so next, I want to look at some calculations. So I'm not going to go through examples in all of these, but I listed some of them. I think we have some homework examples where we calculate book value. So that's a pretty easy one, obviously. Total assets minus total liabilities. And then we also looked at holding period return. That's when you look at the increase in the price of the stock as well as the dividend. Those are the returns that you get in a period. And then you divide that by your initial price when you bought the stock, and that's called your holding period return. I think we have a homework problem on that if you want to take a look. And I think we also did an example where we calculated the price of a share of stock based on the PE ratio and the earnings per share. And we saw that the price is basically equal to the PE ratio multiplied by price per share and earnings per share, sorry. And earnings per share is the same thing as net income per share. So let's go ahead and look at some of these examples now. So these down here, I've got calculations on examples. So let's go ahead and take a look here. Okay. All right, so what I'm going to do is I'll give you the problem, then we'll have a couple minutes to work on it, and then we'll come back and we'll solve it together, okay? So that's the deal for these next, I don't know, 6 problems or something. So here's the question. Find the value of a stock given the below dividends, an estimated stock price of $10 at the end of year 4, and a discount rate of 10%. So go ahead and please solve that problem. All right, let's take a little look at this. So first off, we got a stock price of $10 at the end of year 4. So that means we're going to take the present value of the dividends every year. And the final year, we're going to do dividend plus the price of the stock as if we would sell it. So it's kind of like a positive cash flow. So I'm gonna put down here price of stock, all right, and I'm going to put that in year 4, and that was $10. So now we want to take the NPV of the stock, right? We'll do NPV and we'll do math too. And so I'm going to go right here. Now, when we take the value of a stock, we do not look at the dividends at time 0. Okay? The value of a stock is all about what's going to happen in the future. We do not include dividends that are in process or being paid right now. A lot of times the dividend payments are already determined, like a month or so ahead of time on what's called a dividend X date. So dividends are already determined based on who owned the stock like a little while ago. So that doesn't really enter into our decision whether or not we should buy this stock and what we think the value of the stock is moving forward. So we do not put the dividends at time 0 in our analysis. So I'm going to go right to the NPV function, right? And we're going to put in our discount rate, and then we just start off with year 1, and then we just plug in each year, comma, separating each one, and the final year we do the dividend plus the price at which we can sell the stock. So it's going to look just like that. Okay. And I got 14.07. Here, I'm going to copy the formula so you guys can see what I did here. And so the other way to solve this problem is with math, right? And there we just have to kind of plug it out here. Same thing again, we start off with period 1, and then we divide that by 1 plus the discount rate, all to the power of the number of years in the future. And so that's 1 period. So that's the present value of the dividend at time 1. And then we're going to do the same thing every period going forward. 1 plus 0.1 to the 2, and then plus here, divided by 1 plus 0.1 to the 3. And then the final one, it's going to be the dividend plus the price of the stock. Okay, and then divided by 1 plus 0.1 all to the 4. So it should look like that. And cross our fingers, we should get the same answer that we did do using the NPV formula. And it looks like I think it rounds to the same answer. Okay, so.
Wait, so again, when we find the value of the stock, we're never including year 0, right?
That's right. Yeah, I wasn't sure if we had talked about that specifically. I know that's the way all our formulas are written, but I just wanted to throw it up there just because you never, sometimes when you get financials on a company, it just includes everything. And so you have to pick it what you want out of all the information you're given. And so I just wanted to make that clear. All right, next we had a bunch of these different equations, and a lot of it it was all designed to allow us to estimate a long-term growth rate. And we kind of started off with 2 ratios called payout ratio and plowback ratio. And the key with the plowback and the payout is they always sum to 1. And that's because for every $1 a company has in net income, the thought process is there are 2 things they can do with that. They can either pay it out as dividends to investors, shareholders, or they can plow it back into their business. And so they're percentages, right? So if you do 100% payout, then that means plowback is 0. If you do 100% plowback, then you're paying out 0, because they always have to sum to 1. If you're paying out 50% of your net income as dividends, then that must mean the other 50% is being plowed back in your business. And payout is basically just defined as dividend divided by net income. And what this allows us to do, really, the whole purpose of this is so we can estimate value for the long-term growth rate of the business. And it's estimated by taking this plowback number, what percent of net income that gets plowed back into the business multiplied by the return that they get on equity investments in the business. So that's G. It's good for like stable companies that are kind of growing, not too high, not a lot of things are changing. You wouldn't do this for maybe a company like Tesla, but for bigger, I won't say bigger, but for more stable companies that are a little bit more steady state, then you could kind of use this formula. So let's go ahead and do an example. Here's the question. Find G, the growth rate, for a firm with a dividend of $2.30 per share, net income of $4 per share, and a return on equity of 14.9%. So go ahead, take a few minutes and work on that one.
Professor, I have a question.
Yeah.
So, like, I'm interested in becoming a financial analyst. So these like ratios, these plowbacks and payouts and the growth, like how we're just calculating right now, are these used like within the financial analyst position?
I usually used economic forecasts for the growth rate. Yeah, I didn't, but not to say nobody does. Usually we used some type of economic forecasts. Yeah.
Thank you.
So we got to get ROE, right? And we know to get we need to get the growth rate, and we have ROE. But to get the growth rate, we also need plowback. And so to get the plowback, we go up to this top equation right here, and we see we need the payout ratio. It's kind of like a little, one of those escape rooms, right? It's like piece by piece by piece. And so then we need to get the payout by taking dividends divided by net income. All right, so there we have it, and we can calculate it. And so I got the payout to be 57.5%. And we know this equation right here, right? We know plowback plus payout equals 1. So what that leads us to, let's go ahead and substitute in the payout ratio. So plowback plus 0.575 equals 1. So we know that right here, right? And so that must mean that the plowback ratio is equal to 0.425 based on this equation right here. 425 plus 575 is going to equal to 1. So now we can go ahead and calculate our growth rate. It's just going to be ROE times plowback, right? And we've got the numbers for that already. We know ROE was 0.149, and we know that plowback is 0.425. So I got 6.3%. Any questions on that? Yeah, there are different ways to get G. This is just, one of those where you might be stuck in a situation and you might have to analyze the effects of a company changing, how much they're going to put back into the business. I hadn't worked on a situation like that myself in the past, but what if a company decides to stop investing as much in itself and instead pay out more dividends? This could be a useful tool to analyze that kind of situation. How's the growth rate going to change because of the changes they make? So it's a tool and it's ready for you if you ever need it. Let's take a look at this one right here. And so this is the dividend discount model, assuming we're given constant growth starting at some point in the future. So the first thing is on these, right? Ignore in your PV calculations year zero, okay? That does not belong when you're analyzing stocks. So I'm going to highlight that right up front. I can't remember if I put it in the quiz like that, but we didn't really talk about it that much, but like it is in the formulas. So so just so you don't make that mistake. Now, since we're doing constant growth, that means we're going to use the Gordon growth model at the end. Right? Now, the question here is where to put it. And the way the Gordon growth model works is it uses in its numerator the dividend for the next period. Okay? And that next period is when the constant growth starts. So in this case, we've got a growth of 4% basically starting in year 4. So that means this 2.5 plus all the dividends to infinity are going to be valued in this Gordon growth model. Because that way we don't have to take the present value of dividends going out to infinity, which we don't want to do. So that means this Gordon growth model right here, its value is going to be one period before in year 3. So that's why I'm going to do this. Boop, take that and then divide it by R minus G. So R in this case is 12% and G is 4%. And so it's going to look something like that. Now, what this also means, when we take our present value, these are the cash flows we're going to use. We're not using that year 4 one. The only reason for this one right here is because it goes into our Gordon growth formula right here. Okay? So when I take the value of this, it's going to look something like this. And then we combine the dividend and the Gordon growth model. So it looks just like that. Okay. Let's take a look at the math side of that. So if we were to do the math side, it's going to look something like this. 2.1 divided by 1 plus 0.12 to the 1 plus 2.2 divided by 1 plus 0.12 to the 2 plus 2.4 plus the Gordon growth model, 31.25, right? And then divide that whole thing by 1 plus 0.12 to the 3, power 3. So that would be, this would be how we would solve it with math. Now let me point out another thing here. You should be able to solve this if I, gave you fewer years of dividends, right? If I only gave you 3 years of dividends and I said the constant growth starts in year 3, then you should be able to go in there and solve that. If I gave you 6 years of dividends and I said the dividends start growing at a constant growth rate starting in year 6, you should be able to solve that too. The only difference is we have more, single dividends that we have to take the present value of. And the whole, the crux of everything is to do this in your final dividend to be discounted back to time 0, is that you also include the Gordon growth model, which then uses this dividend out here. I got a question. Can you go over how you got 31.25? I got 30. Here's the formula I used for getting 31.25. It's basically the dividend at time 4, which is 2.5, and then you divide it by the quantity R minus G. R is 12% and G is 4%. So check that out. All right, let's take a look at NPV. Find the NPV of a project with an upfront 8.9 capital investment followed by the following positive cash flows. Let R equal 10%. So go ahead and calculate the NPV of this project, and I will give you I'll give you a minute or so. All right, so let's go ahead and calculate the NPV here. First thing, though, we have to put in that negative cash flow, the 8.9 capital investment. Just remember, upfront capital investments, I can't remember a situation where it's not a negative cash flow. So let's go ahead right in here, and I'm going to put in a negative 8.9. Okay? So capital investment will be a negative cash flow, at least in year 0. There could be more later on, but at least year 0 is going to be. And then let's go ahead and calculate NPV. And to do that, what do we do with that 8.9? Is that going to be inside or outside the NPV function?
Outside.
Right, because that NPV function, it only looks at year 1 and onward. So the first thing is, let's take that by itself. It's already in year 0 anyway, so we don't have to do anything with it, time value of money wise. And then we use our NPV function. We give it our discount rate that we need. And then we start at year 1, comma 2, comma 3, comma 4. And so pretty simple. Let's see what we get. Negative 166. I'm going to go ahead and copy the formula here so you can see it. There's the NPV formula. And the math formula is going to look something like this. First, we have the negative 8.9, right? And then we add the present value of 2.1, which is going to be 1 plus 0.1 to the power of 1. Then we add the present value of the 2.2, 1 plus 0.1 to the power of 2. We do that all the way out to year 4. I think that's it. And that'll give us the exact same answer. So next question, invest given this NPV of negative 1.66? No? Yeah. Looks like the no's have it. Yeah, negative NPV, you don't invest. That's a pretty simple rule. And yeah, if you get that question wrong on the, let's say the final quiz, if I ask that, I'm afraid you're not going to be able to pass the class, and you're going to have to retake the same class with me again. Okay, so don't miss that rule. NPV has to be greater than 0. Okay. Okay, let's take a look at internal rate of return, or IRR. Please go ahead and calculate the IRR for this project. Assume an upfront capital investment of 4.9, followed by the following positive cash flows. All right, let's check out this IRR. So the first thing is we need to put in that negative cash flow. And then we're going to go ahead and calculate IRR. I'm not going to do the math version of IRR. So even you math diehards, you're going to have to use Excel or financial calculator to do this, okay? And now don't forget this. You click on the time zero cash flow with your mouse, and then you drag and you let go of your mouse clicker, and that way you can select the range of the cash flows, hit your end parenthesis, and there's your answer. But and it looks like Kevin got this. Don't forget this step. Excel defaults to do 2 decimal places, which is 1 percentage point. We usually need more refinement than that. And so make sure when you're doing IRR, just go in and increase the number of places to the right of the decimal point, okay? And so here the answer is 29.82%. So if the cost of capital is 9.9%, should we invest in this project?
Yes.
Yeah, let's do it. Heck yeah. That's the formula I used. But this formula, this IRR formula is very fussy. It only likes things a certain way. If you do this, let's see what happens. I think I'm going to get an error if I do this. What did I do wrong?
No, Professor, you didn't do wrong, because in IRR, you cannot choose many numbers.
I'm trying to show you that it's going to make a mistake, and
before.
it won't even let me do that. Yeah. Yeah. So IRR doesn't work like NPV, right? IRR, you have to select the range. Come on, just go. Okay, you have to do the formula like this. So when you make sure you've got your Excel open during the quiz on your computer, so you can go ahead and do this. Where did I get 9.9%? I just made that up as part of the question. So the question was, should you invest in this project if the cost of capital is 9.9%? Yeah. And the key here is that our IRR is greater than that cost of capital. And so that's why we got a yes. Okay. All right, let's take a look at payback now. So find the payback period in the whole number of years of a project with an upfront 10.0 capital investment. Okay, we got 5 years. So let's see what we get here. So the point with this payback period, right, is we calculate the cumulative cash flow after year 0 for each year, right? So in year 1, right here, what's the total cash flow we've gotten up to year 1? It's just going to be year 1, right? So by the end of year 1, we have 2.1 back, and that's not enough to pay back our initial investment. Here was our initial investment. I'm sorry, I didn't put it in. It was minus 10. And what we're doing is we're going to compare the cumulative cash flow up to that point with this initial investment right here of $10. That tells us how much we've made so far by the end of year 2, and that's 4.3, but that's still not enough. After 3 years, we've made this much back, 6.7. That's still not enough. After 4 years, we've made this much. That's still not enough. But check this out. In year 5, we're going to have cash flows of 2.5, right? And we only need 0.8 more. So you can pretty much see that the answer is going to be 5 years. It took us 5 years to earn back that initial 10 investment. So the payback period is 5 years because it took us 5 years to earn back the $10 investment. Okay, so let's say for our company, the cutoff for payback period is 4 years. Does that mean we invest or we don't invest?
Don't invest.
Right. So that's a big no. Right, the key is the faster the payback, the better the investment is. That's the key with it. It may surprise you, with some of the, investing in solar panels has been pretty big the last, 10, 20 years. And as I recall, payback period on solar panels, for some reason, the numbers like 8 to 12 to 15 years stick in my head. I can't remember what it is, but I think I remember one of those solar companies talking about that. Okay, so that's all I have for today. I uploaded this spreadsheet and you should see it under the week 11 folder. When the video of this lecture, when it's done rendering, it's going to take a little while, and then I have to edit it. That'll be up later tonight, okay? And so don't forget, homework on Sunday is going to be delayed a week. I haven't announced it yet with email, but I will. And take the quiz sometime between tomorrow at 8 and the end of Wednesday. And you use whatever browser you want. There's no webcam. You can backtrack. So it's a little bit of free willy. So that'll be fun, right? And what else? I think that's it. So I wish you guys good luck. And I will, and there's no class on Wednesday. You know that, right? Because you guys are going to be taking the quiz. Yeah, the exam is timed. It's just like the previous ones. It's going to be 60 minutes. Yeah.
Just to clarify for the quiz, you said no backtracking?
You are allowed to backtrack.
Okay.
Yeah, I've removed that based on survey results.
All right, because I had difficulty with other ones like that. Thank you.
Okay. So you guys are all done. Thank you.